We're told that money makes the world go round. The coins and notes in our pockets are the engines of our reality. But what if that isn't the whole truth? What if the real power isn't in who has the money, but in who controls the debt? Modern banking wasn't an evolution. It was an invention. A series of inventions, perfected over centuries, designed to concentrate power. This isn't a conspiracy. It isn't hidden. It's the story of how a small group of financiers figured out the game behind the game. From the families who financed kings in Florence, to the secret meeting that created the American Central Bank. This is the story of the system that now runs the world. Let us pull on that thread. To understand this invention, we have to go back, before coins, before paper, before kings, to ancient Mesopotamia, around 2000 BCE. Here, etched into clay tablets, we find the first recorded contracts. They were not for money. They were for debt. Farmers borrowed seeds, promising to pay them back with interest. Traders took loans of silver to fund their caravans. Think about that for a second. Debt is older than money. The first money was not a coin. It was a promise, an IOU, a record of who owed what to whom. For thousands of years, economies ran on credit systems like these, on trust and tally marks. But this was a tool for a village, not an empire. For this simple promise, etched in clay, to become the engine of global power, it needed to be institutionalized. It needed a new kind of organization. That institution was born in 15th century Florence. In 1397, Giovanni de' Medici founded a bank that would change everything. The problem then was simple but profound. First, shipping gold and silver across Europe was incredibly dangerous. Second, the Catholic Church forbade charging interest, calling it the sin of usury. And here is where the genius comes in. The Medici first perfected double-entry bookkeeping, allowing them to track credits and debits with a new level of precision. But their masterstroke was the letter of credit. A merchant in London could deposit his gold in the Medici branch there and receive a simple letter. He could then travel to Venice, present that letter to the Medici branch there, and withdraw his funds. No gold was moved. The risk was gone. And the sin of usury? The Medici sidestepped it by dealing in different currencies. They would take a deposit in one currency and pay it out in another, building a profit into the exchange rate. The consequence of this was revolutionary. The Medici Bank became the financial backbone of Europe, the personal bankers to popes and kings. They demonstrated that the real power was not just in holding wealth, but in managing the debts of the powerful. They had written the blueprint. The next chapter takes us to 17th century London, not to a grand banking hall, but to the humble workshop of the city's goldsmiths. The problem was simple. People with gold needed a safe place to store it. The goldsmiths had vaults, so they began accepting deposits and issuing paper receipts for the gold they held. Soon, people realized it was easier to trade the paper receipts directly. They began to circulate as if they were money. And here is the moment that changed everything. The goldsmiths had a profound realization. They noticed that on any given day, only a small fraction of the depositors ever came back to claim their actual gold. Their innovation was as simple as it was audacious. They started to issue more receipts than the gold they had in their vaults. They lent these extra receipts to borrowers and charged them interest. This was the birth of fractional reserve banking. They were, quite literally, creating money out of thin air. Money born not from a physical asset, but from a promise to pay. the entire system was held together by confidence. As long as everyone did not ask for their gold back at the same time, the illusion held. It proved that an economy could run on promises created by a private institution. But this was still a backroom scheme. The real revolution would come when this trick was scaled up, legitimized, and placed at the very heart of the state. That moment arrived in 1694. King William III was broke, desperate for money to fund England's war against France. A group of private financiers saw their opportunity. They made the king an offer. They would lend the government £1.2 million. In exchange, they demanded a royal charter to establish a new private corporation, the Governor and Company of the Bank of England. This was not a government bank. It was a private bank, owned by stockholders, that was given the exclusive right to act as the government's banker and manage its debt. Its central innovation was monumental. The bank was allowed to issue banknotes. But these notes were not fully backed by gold. They were backed by the government's debt, by its promise to repay that initial loan using future taxes collected from the public. The consequence of this cannot be overstated. For the first time, an entire nation's money supply was officially tied not to a tangible commodity, but to perpetual government debt. The bank had the power to create money, lend it to the state at interest, and have that interest paid back by the taxpayers. The private scheme of the goldsmiths had been transformed into a state-sanctioned machine. This became the model for almost every central bank in the world today. With this blueprint perfected in England, the stage was set for a new kind of dynasty. Enter the Rothschilds. The family's story begins with Meyer Amschel Rothschild in the late 18th century. While the Medici had created a network of branch managers, Meyer Amschel had a more potent innovation: his 5 sons. He sent them to the financial capitals of Europe, London, Paris, Vienna, and Naples, while one remained in Frankfurt. This was not just a banking network. It was the world's most sophisticated private intelligence agency. They could move information and money faster than any government. Their most legendary feat came during the Napoleonic Wars. Nathan Rothschild in London received news of Napoleon's defeat at Waterloo, a full day before the government's own riders. He used this information to make a fortune on the London stock market, cementing the family's dominance. The Rothschilds became the ultimate power brokers. They financed governments, funded Europe's railways, and provided the loan that allowed the British government to purchase the Suez Canal. They had refined the Medici model to a global scale, proving that by financing governments and controlling the flow of debt, a single family could influence the destiny of nations. But the age of family dynasties was ending. The blueprint was about to be modernized and imported to the world's rising economic power, the United States. In the early 20th century, America was deeply suspicious of central banking. But a series of financial panics created an opening for change. In November 1910, a group of the nation's most powerful men boarded a private train car for a secret journey to Jekyll Island, off the coast of Georgia. The group included Senator Nelson Aldrich and representatives of the banking empires of J.P. Morgan and the Rockefellers. For 9 days, they met in total secrecy. They knew the public would never accept a bank openly controlled by Wall Street, so their plan had to be clever. Their innovation was to design a system that appeared decentralized and public, but was in essence privately controlled. They proposed a system of regional reserve banks overseen by a central board. This plan, with some modifications, became the Federal Reserve Act, signed into law in 1913. The consequence was the ultimate victory for the inventors of debt. The Bank of England model was now installed at the heart of the world's emerging superpower. The power to create money by issuing debt was handed to a quasi-private consortium of banks. Far from preventing crises, the Fed's early policies are often blamed for worsening the Great Depression. The final piece of the global architecture was in place. From ancient Mesopotamian clay tablets to Medici letters of credit, from the London goldsmiths creating money from trust to the Bank of England, turning government debt into a national currency, and finally to the secret meeting on Jekyll Island. This system was not an accident. It was the result of a series of deliberate inventions, each one designed to concentrate power in the hands of those who control credit. Today, the majority of money in the world is debt, created from nothing at the moment a loan is issued. And herein lies the system's inescapable logic. To pay back all the debt that exists, plus the interest, more money must be created. And since most money is debt, that requires issuing even more debt. It is a perpetual motion machine. Your mortgage, your student loan, your nation's deficit are all cogs in this vast machine. That is a gap worth sitting with. The inventors of debt did not just build banks, they built the architecture of the modern world. And they built it on a foundation of promises. If you believe it's important to understand the systems that shape our world, make sure to subscribe and hit the bell. Because you cannot think critically about something you have never been asked to examine.